Welcome to the Executive Forum Speaker Series from Purdue University's Daniels School of Business. I'm your host, Dave Randich, and I'm a lecturer here at the Daniels School, teaching undergrads on the West Lafayette campus. Executive Forum brings students and industry leaders together. Our speakers inspire our students and the public with insights on trends in their industry and guidance for students as they develop their business leadership skills. Today, we welcome to our Executive Forum top banking professional, Tim Marshall. Come along with us as we build the future of business.
You've had a lot of success at your assets under management have increased 12 times in the 20 years you've been at the bank. And so that's why we want to really listen to you here today. And as a matter of fact, I'd love to have you come to my classes the rest of the day. I have 4 more classes. Maybe you could get jacked up before we get started, right? So let's get right into the headlines. We see inflation maybe still high. We see interest rates, lots of tug of war. What should we do about that? You're in the industry. What do our young leaders need to know about these dynamics?
Okay, we'll just hand this back and forth. Interest rates are an interesting concept, and there's very little stability over time. There have been some periods where we've had longer periods of consistent interest rates. I think back to 2008 was the start of the Great Recession, the financial crisis. The Federal Reserve, under the leadership of Chairman Ben Bernanke, took rates quickly to zero, and they operated at a 0%, 0 to 25 basis points, which is essentially zero, and from 2008 to 2015, and that was one of the longest periods of essentially zero interest rates in the history of the country. And then Janet Yellen took over the leadership of the Federal Reserve in 2015, and the inflation at that point was 1.1%, and the Fed was getting concerned, so they increased interest rates in 2015. 1 year later, they increased them for a second time, and they eventually got them up from 0 to 0.25 to 2 to 2.25 in 2018, and just held them there. Inflation never became a contributing factor. And then the pandemic hit in 2020, and we all know what happened subsequent to March of 2020. Interest rates fell, and then back to zero. But then inflation started to pick up due to all the supply constraints. We couldn't get product. The Federal Reserve, the common conversation was it's transitory. We'll all remember them talking about transitory inflation, that they just thought it was a mild interruption, and then in fact it was not transitory. Inflation got up to 9%, and in 2022, they began the process of significantly increasing interest rates to the point of, their first increase was 75 basis points. The interest rate decrease we got on Wednesday was 25 basis points, and typically it's in that 25. So to have them increase by 75 and then follow by 50, that was problematic for the banking industry and for many industries. But took the rates up and started to bring them back down. And as you said, Dave, it's controversial. I mean, inflation is still north of the 2% target. It's at 3%. And but unemployment is increasing. The jobs report for the month of August was 22,000 new jobs created. And I just don't think the Fed can get away from ignoring the fact that the job market is problematic. So they did a 25 basis point decrease. The markets are projecting another one in either October or December, and we'll see. It's a difficult proposition today because their mandate is anybody that's taken econ classes that it's a dual mandate: employment and inflation. And in today's environment, employment is problematic, and inflation is problematic from a high side perspective. It's not at 2 and it's not below. So they do risk the risk of lowering rates and then pushing inflation higher. So,
And Tim, I know you're interested in affordable housing, both in terms of your philanthropic efforts and also through your bank. And affordable housing is going to affect a lot of our young people here, and it's a problem nationally. What are your thoughts on that relative to these indices? What do you see going on there?
well, housing is an issue, and it's. I think, is your point, David? It's not based on individual communities or individual states. It's, as you pointed out, it's a national issue, and there's no easy fix. If you look back over recent history and you see what's driven some of the challenges in the housing market, I can think of 4 or 5 variables. One is just the demand completely outstripping supply. So there's been more people in the housing market than there are new construction or people willing to sell. So anytime you have an imbalance in demand and supply, you know what's going to happen. Prices are going to go up. And so in turn, we now have a problem with pricing. I saw recently that the average price of a home nationally is now $408,000, which is up $100,000 since 2019, and so you've got pricing considerations that is difficult for people at the lower end of the income stream to be able to figure out how to buy a house. And if you go to a major market, it becomes even more problematic. One of the advantages for Ann Arbor over a Silicon Valley or a New York or a Chicago is our cost of living is less. And so we're doing a really wonderful job of recruiting companies from the Valley to Ann Arbor because the cost of employment and living is much less. The other factor, we've even talked about this, was just the whole zoning, the growth in zoning restrictions. And we see it today with, the uproar over data centers. You can't pick up the paper without seeing a group of citizens just in an uproar and typically very vocal about why they don't want a data center in their area. I call that the NIMBY approach. Not in my backyard. We want affordable housing, but by God, don't do it in my neighborhood because I don't want those people around. So you've got the whole zoning aspect, which has negatively impacted supply, construction. The fourth component, I think, would be interest rates. Rates have come down. They had been for some time in the 7% range, which historically, you and I are a little bit older than this universe.
It was a good deal.
It is a good deal. I think my wife and I bought our first home, and our interest rate was 9%, and we thought, hey, no big deal. It's just the cost of getting into real estate. But it's come down from 7. We lost some more this week. I think that the national average is now down maybe around 6.25. But still problematic when you're buying your first home. I saw somebody when I said 9% gasp a little bit, but it's an incremental increase to the cost of home ownership. And I think the last factor that I would point out is just the investor community. That studies have shown that upwards of 25% of all homes over the past 4 or 5 years have been purchased by investors as opposed to individuals, and they will create a competitive imbalance at the time of purchase because they are a cash buyer, and most individuals trying to get into their first home have to have some equity and bank debt.
Yeah. So we got to get ready for this, right? This is going to last a while. Tim, let's go over to your business. And we're sitting here on Purdue University's wonderful campus, and you're up by the University of Michigan in Ann Arbor. And I think one of the things that's fascinating about your bank is a large percentage of your assets under management are allocated to the startup culture up at the University of Michigan in Ann Arbor, supporting startups, particularly in tech and life sciences. Please tell us about that and that relationship you have with the university.
Uh, Good question, Dave. And I think I would like to start with it's an evolution of a company. Our bank was opened in 1996, and uh, I- we opened with 15 employees. I was the second CEO. We still have 4 of the 15 employees still on the payroll. 2 have recently retired. Uh, But I think as the bank evolved, we started kind of as a private bank, a business bank, kind of that low hanging fruit that we were going to be able to be a high touch institution to business owners who were dealing with changing policies, more further away decision making being done, and so that was our first foray. Then we started wealth management in '97. Uh, and then we started our tech and life science banking group in 2004, and the whole premise behind that was to recognize the incredible resource that we had, 6 blocks down the road for the main campus of the University of Michigan, and then subsequent to that, former Governor Rick Schneider and Mary Sue Coleman, who was the then president of the University of Michigan. Mary Sue had a strong bent on entrepreneurship, uh, on commercialization, taking inventions by the researchers and the faculty at the University of Michigan, and let's create some revenue behind it. And so Ann Arbor Spark was started to be the economic driver for Washtenaw County, and it was a segue from historical economic organizations that were catering to the real estate community. The predecessor was called the Washtenaw County Washtenaw Development Council. And on the board, there were 20 board members, and 18 of them were real estate developers. Well, now the board of Ann Arbor Spark, if there's 20 board members, 18 of them are entrepreneurs or people serving that community. And so, long story short, if I just look back to last year as an example, the University of Michigan had 673 inventions that came through their tech transfer area. They had 31 startups. Ann Arbor Spark had 62 startups. And so the Bank of Ann Arbor has developed a niche where we're working with these startup companies and helping them at a very early stage, introducing them to angel funding, pre-seed funding. Eventually, we hope that we can get them to a venture capital funded operation, and then possibly an exit. We just had a large exit with a company that is in the biochemistry area, and they did a $2.3 billion exit. And so that's kind of yeah, I mean, Ann Arbor Spark, the other opportunity is all these companies are as they reach whatever stage they're at in terms of the business formation, they will have different banking needs. But they typically all bring very large deposits, which is the catalyst for a bank. Deposits are on our liability side of the balance sheet. Loans are on the asset side. But we use deposits to fund loans and economic growth. So,
Well, to have a local bank that can support entrepreneurs and startups and that whole culture that's going on up there is just terrific. And I'm sure you're proud of being a part of that.
it's really an amazing culture, and And yes, and over time, over the past 20 years, we've really developed a niche, and we compete with you name the bank, but we can be extremely competitive.
That's amazing. And let's go to another avenue of growth. I know you've done acquisitions over the years, and typically we'll look at a spreadsheet to see if an acquisition makes sense. As a CEO, Tim, when would you walk away from a acquisition, even though you like the numbers on the spreadsheet?
Yeah. Well, that's a really good question. It's a timely question. Our first acquisition we did was in 2010, and it was an FDIC assisted transaction. And back in those days, post Great Recession days, and early on, the FDIC essentially paid the bank to acquire the company. So it was like,
so this is during the financial meltdown.
Yeah. Those are I only did one, but I wish I could have done 20. And then we did an equipment finance acquisition in 2013, which very fledgling operation had 10 or 12 million in assets on their balance sheet. We just went over 325 million in assets in that subsidiary. And then we did a bank acquisition in 16, and 2 banks more in 2021 and early 2022. And then just recently, I was called because our bank is extremely high performing. It is very well recognized, not only in our community, but throughout the state of Michigan, uh, as a desirable place to work, a desirable place if you're going to sell your bank to potentially combine forces with our bank. And I got called on an opportunity earlier this year and spent a day with our chief operating officer touring. Had dinner with the CEO. We had dinner with the CEO and one of their directors the night before, then spent the whole next day seeing all their locations. And the numbers were incredible. I mean, it's just the liquidity that this bank would have provided, because they had significant amount of deposits on their liability side of their balance sheet and much less loans on the asset side. And we are a liquidity needed institution because our loan team is so successful that they continually out generate loan growth versus deposit growth. So there was a number of factors that caught my attention, and then I wanted to do the transaction. And at the end of the day, the culture was not a right fit. The demographics were not the right fit. Geography was not the right fit. And we probably did this tour on, it was maybe Monday night, dinner, Tuesday, all day tour. And the bank was having a board meeting the following Monday, and the CEO wanted to do a deal with Bank of Ann Arbor. And I had the unenviable job of calling him on Friday and informing him that we had made the decision that we were not going to be going any further. And it was for those reasons: geography, demographics, culture, the economic vitality of the communities that they served was not what we were accustomed to. And so our concern was, if we make this significant investment and buy this operation, is this just an eventual runoff in deposits as the communities continue further depression, if you will? And then the other concern was that the headquarters of the bank were in a town of 800 people, and we would probably likely, have the difficult decision of separating with, 25 or 30 of those people in a very small community. And that just wasn't the message that I wanted to send.
Yeah, well, it's terrific that you could walk away from something that you didn't think was going to work. We talk in school about only half of acquisitions are actually successful.
Yeah.
Right. So you talk about how strategically it fit because of the liquidity, and look good on paper, right?
Yeah.
Financially.
Yeah.
But then you got to get into all the intangibles and all the other issues. And if you can't run it, you walk away, right?
Exactly. And there's no panacea with an acquisition. I mean, yeah, I read about it, all of them in the industry, and I'm a similar type of conversationalist that you think the culture is similar, you think the culture is going to be a great fit, but at the end of the day, there's an acquirer and there's a seller, and it's a it, there are challenges to get everybody together, and particularly to assimilate the company that's been sold, which none of their employees understand. Everybody's like, why would we sell this bank? I mean, it's a 100-year-old charter, and we all loved what we were doing, and now we're sold, and now we're reporting to Tim. So there's always some challenges, even as good as the fit is.
That's it. And Tim, I'm gonna sneak one more in here before we turn it over to the students. Let's talk about careers. So a lot of my students want to go to New York, investment banking. They describe it as the most competitive, lucrative opportunity in the world. You name it, private equity. A lot of people say they want to be wealth managers now. You've had tremendous success in the Midwest.
Yeah.
And I know there's a lot of places in the United States and a lot of businesses where people can be fulfilled and successful. How do you, for finance high flyers, what are the pros and cons of making it big, trying to make it big in New York, or following a different path?
Well, one thing, Dave, I've never done is I don't speak poorly about my competition or other opportunities for employment.
So we're being recorded anyway.
Yeah, not while we're being recorded, but I guess I would just use myself as an example. I had coming out of Purdue, I had 7 job opportunities in Indianapolis, Chicago, San Francisco. And I can only talk about myself, but I chose Indianapolis, and I would never second guess the decision that I made. And what I would say is, if you want to pursue a dream, go do it. But keep my card, and about 3 or 4 years, send me an email and tell me you're looking for a job that you'd really like to do in the Midwest, and get back to a more friendly environment and a better life, work-life balance.
Tim, on behalf of Purdue University, the Daniels School of Business, and the Executive Forum, thank you so much.
Thank you for joining us for this episode of the Executive Forum Speaker Series. Learn how the Daniels School is building the future of business by visiting us at business.purdue.edu. That's business.purdue.edu.